FMC Corporation is a global agricultural sciences giant. They manufacture the chemistry that keeps bugs, weeds, and fungi off crops in over 100 countries. It is a massive physical operation spanning the globe, but the market is treating this sprawling empire like a terminal asset. In 2025, FMC posted a $2.24 billion net loss. They were booted from the S&P 500, and credit agencies downgraded their debt to junk status. The reason for that punishment comes down to a brutal mathematical imbalance. The company is carrying $4.5 billion in gross debt, weighing against a severely diminished market capitalization of roughly $1.7 billion. Wall Street has looked at that math and made up its mind. At roughly $13 a share, every active lawsuit, every margin collapse, and every downgrade is fully baked into the price. The consensus is a terminal spiral. When the market prices in absolute destruction, it rarely leaves room for nuance. Analysts have assigned approximately a 0% probability to FMC's actual structural recovery levers. To figure out if that pricing is accurate, we have to split the company in two. We will use a thesis ledger to separate the documented balance sheet distress from the growing intellectual property pipeline. On the negative side of the ledger, the threats are real and structural. We have an extreme leverage ratio of 5.7x and a total collapse in profit margins. On the positive side, we have to weigh the unpriced optionality, an accelerating revenue stream from next-generation intellectual property, and a $175 million cost-cutting mandate. Finding value here is not about ignoring the massive debt load. It is about calculating whether those unpriced assets offer an asymmetric reward if management simply avoids bankruptcy. FMC's golden era was built on a class of patented insecticides called diamides, headlined by a blockbuster molecule named Rynaxypyr. Because they held the patents, they held monopoly pricing power. That era ended with a patent cliff. Across major global markets, the core diamide patents expired, and FMC instantly lost exclusivity. The market consequence was immediate. Generic manufacturers, primarily out of China, flooded the supply chain with identical active ingredients, pricing them 50 to 80% below the branded versions. The monopoly became a commodity overnight. Top-line revenue fell from a peak of $5.8 billion in 2022 to a projected $3.47 billion for 2025, a 40% contraction. Simultaneously, gross margins permanently compressed from above 45% down into the low 30s. The legacy diamide business is structurally impaired. Any investment thesis waiting for FMC to return to its 2022 financial profile is waiting for a mathematical impossibility. With revenue shrinking, the immediate systemic threat is liquidity. FMC's capital structure has exhausted its flexibility. Gross leverage spiked to 5.7 times, driven by $4.5 billion of debt against just $670 million in EBITDA, pushing them near covenant breach. Through Amendment Number 6, FMC pledged physical assets as collateral, giving banks a first priority claim over equity holders. That structural shift creates a severe problem because a massive maturity wall is rapidly approaching. They absolutely must refinance $500 million in senior notes by October 2026, and they will have to do it at punitive rates. They are trading an expiring 3.2% interest rate for a secured high-yield issuance that will likely exceed 8 to 9%, draining even more cash into interest expenses. Compounding this liquidity crisis is how long it takes them to get paid. Day sales outstanding hit 253 days, meaning it takes over 8 months to collect cash from agricultural distributors. That slow collection cycle drove a massive free cash flow burn of $628 million in the first quarter of 2026 alone. The operation simply cannot generate the cash needed to pay down the principal. FMC is mathematically trapped. They cannot borrow their way out, and organic cash generation is sitting at zero. Survival now depends entirely on selling off external assets and executing aggressive internal cost cuts. But amid the wreckage of the legacy business, one specific segment is actually growing: FMC's dedicated research and commercialization of new patent-protected active ingredients. The company has 4 next-generation molecules moving into the market. The standout is Dotalex, which represents the first genuinely new herbicide mode of action introduced to agriculture in over 30 years. The adoption rate is aggressive. Sales of these new active ingredients doubled year over year in the first quarter of 2026. Management projects the next generation pipeline will scale toward $300 to $400 million in revenue this year. Because these patented molecules command structurally higher margins, this highly profitable new segment is expanding to offset the shrinking $3.6 billion legacy business. If this pipeline achieves real scale, it shifts FMC's overall revenue mix back toward high-margin chemistry, creating a path to restore long-term enterprise value. To bridge the gap between today's debt crisis and that future pipeline, CEO Pierre Brondeau is running an immediate 4-pillar turnaround strategy. The first 2 pillars focus squarely on cash retention. They are selling off FMC's India commercial business to fund direct debt reduction, while executing Project Foundation to secure $175 million in annual cost savings. Pillar 3 is the aggressive international commercialization of that new intellectual property pipeline we just mapped out. We are seeing evidence that the market is absorbing this execution. By early May 2026, management confirmed they had already secured 50% of the required second-half direct sales in the critical Brazilian agricultural market. Finally, the 4th pillar is a formal strategic review. FMC holds over 700 global regulatory approvals, a footprint that would cost competitors billions to replicate, which opens up significant merger and acquisition optionality. These 4 levers provide management with a narrow, controllable path forward. They do not need a miraculous macroeconomic recovery to survive. They just need to execute these specific steps to maintain covenant compliance. Looking at the next 12 to 18 months, we can synthesize these data points into a distinct matrix of outcomes, pitting the extreme balance sheet risks against the IP and M&A upside. In the bear case, the asset sales fail to close on time. The $500 million refinancing triggers punitive interest rates, EBITDA drops, and a covenant breach forces a highly dilutive restructuring that wipes out equity. The base case assumes the company generates just enough cash to reduce total debt by roughly $700 million. Leverage stabilizes near 5.0x. The company technically complies with its covenants and survives, but with exactly 0 margin for operational error. Then there is the bull case. The high-margin intellectual property pipeline hits its upper revenue targets, and the strategic review initiates a premium buyout or breakup, unlocking the trapped value of those next-generation patents. Right now, the valuation mechanics are tightly compressed. The current $13 to $14 stock price acts as a hard floor, supported by the inherent M&A value of the intellectual property. Meanwhile, the crushing debt load acts as an absolute ceiling on any multiple expansion. This makes FMC a highly specific type of investment. It requires a 3 to 5 year horizon and a strong stomach for deep distress volatility. Buying the stock at these levels is a rigorous mathematical wager. You are betting that the market's absolute certainty of bankruptcy is flawed, leaving substantial, unpriced upside in its intellectual property and operational turnaround.